Hey traders, I wanted to create a video showing how I use the options data for the current day and how I feel it benefits me for setting up trade plans, areas of potential support, resistance, or a breakout. Even if you don't use options for your trading during the day, this is something that you can use on any stock that has options market for the underlying, whether it be 0 days, weeklies, monthlies, and the calculation is very useful in letting you know what the entire market has priced in for a potential move, high or low. The calculation is referred to as expected move. One of the things you will need is access to the options chain. So even if you've never traded options, don't let this scare you away. I'm going to pull up SPY here for May 23rd. Personally, I like to use the 0 days to expiration and the Friday expiry for that particular week. What you need to do if you don't have access to a tool that calculates the expected move for you is you need to look at the call and the put for the same strike at the money. So you would look at the 418 or the 417. It doesn't matter which one, as long as you're using the same strike for the call side and the put side. So just the same row here. Then you simply add the two values together. You can do either the bid or the ask. It really doesn't matter, especially on a stock that is very tight on the spread. So there's only a cent difference here. So it really does not matter. And I've got a spreadsheet here that I use if I'm doing it manually. You also need the current price of the stock. So I look at 417 here. I've got my call and my put costs, and I come out with an expected move of $2.22. Then you can take the current price of whatever you're looking at, in this case SPY, you add the expected move and you subtract the expected move, and you get the high price and low price expected for that day, in this case May 23rd. Now I take this and plot it on my charts, so I have my two lines here. And then another thing I like to do is plot my fib tool from the top to the bottom. Especially important is the 0.5. Now the trick of this is that 0.5 will always be roughly right where the price starts, and that's just because that's where the options data has started for that priced in move. Now this helps me generate some sentiment for the price action. So as the day progresses, when we're over the 0.5, then I'll look to go long, as long as we're not close to the high level. If we're below the 0.5, I will look to potentially go short until we're about down here. Now, if I've missed most of the day, maybe I'm busy, I don't get to check in, then what you can do is you come in here, you've got your data already plotted, and you take a look. If we're already up here, perhaps we're going to come back to 0.5. Or you can watch for a breakout and a retest. Perhaps we're at lows, same thing, breakout, retest for lower, or we bounce and we come back. Now, the reason this works is because the options market is a myriad of hedging and speculative betting on the direction of the market, and the market takes into account a myriad of factors: economic, earnings, you name it. If it's for a specific company, it could have a whole lot of things that are taken into account for that specific company, but it could also be affected by something the entire market is doing. So how did this work for May 23rd, 2023? So I'm going to start playing the bars back here. If you've used the Fibonacci tool, you'll know that the 0.65 and the 0.615 area is considered the Fibonacci golden pocket. It is something that is employed frequently by Fibonacci traders. They love to see price action around here for a potential trade entry. So currently right now you may think, okay, we're over 0.5, potential for longs. So let's see what that price is going to do. Strong rejection back down. Still trading around here. So I think personally a lot of people would have already been chopped up here, but with this information, you're watching and you're looking for a potential breakout or strong rejection. And there you have it. So now that you've looked at this, where are we going? Very powerful stuff. So you notice how each leg This being the expected move low price. We reject once, come back, break right back into it, and we drop through that price. Ultimately, we retest right underneath before failing again to come back below. So you even had a chance to short from the expected move low price. So this is just something I wanted to detail in a video. It's something I have employed as an auto plot. I have a script that auto calculates this both for the 0-day contracts on SPY as well as the Friday expiry, and I find it to be an incredibly useful tool. I look at these levels, I draw my fib tools on them because I see things like this. One of the most important aspects of the fact that these levels are based off of the options market is the expected move is within a standard distribution, which is, if you've ever heard of the bell curve, is based off of a 68% range. So when you put these levels on your chart, it can be expected that price will stay within these levels 68% of the time. So that's a very powerful concept when you really stop to think about it. You have price levels on your chart that are 68% of the time going to be quite effective for trade setups, either as a target or a reversal strategy or whatever potential setup you like to use. 68% of the time, these levels will work for your needs. You can use the fib tools to generate ranges beyond the expected move, like this level right here, and you can see how effective that price was. So for me, I like to keep it simple. I just grab the expected move just how I showed you here. You add the call and put prices together. That gets you your expected plus minus price. Then you add that to the current price and subtract. Those become your levels. And you can do this for anything. It doesn't have to be 0-day. So for, Nvidia or Microsoft or Apple, you can take the Friday expiration and do the same thing. And it might be effective for a scalping strategy or a swinging strategy, you name it. I mean, to me, it's quite clear that there's a lot of confluence with fib and expected moves. And if you don't want to spend all your time plotting things and looking at various time frames, the days, weeks, months before, I would highly encourage you to take a look at the expected move calculation, because the market has actually already done a lot of that work of finding key levels and understanding in ways that most traders probably can't the impacts to the market from economic, from the Fed, from bank collapsing, whatever. I don't have a lot of time to prepare for all the different things. I don't want to spend a whole lot of time reading news and trying to figure out where things might go and where things might react. So I would much rather just let the market do that for me, and I'll take that information and plot it on my charts, and I'll just use it. Again, the expected move, definitely something I would highly recommend you look into, because I think if you didn't have these on here, this is lower high kind of pattern here, but this gives context as to exactly why this price moved exactly where it did, and I think that's quite powerful. Just wanted to introduce this to anybody that may be struggling, or maybe just find this useful. Maybe you're not struggling, but maybe this will be an additional piece of edge for your trading. Leave a comment if you found this useful, or if there's something else that you use the options data for. It would be really cool to check out. As always, happy trading, and thanks for watching.